Okay, we'll give it a few minutes. Let me just see something. Good morning, everyone. We're just letting just a couple of minutes for everyone to log in. Okay. Well, people are logging in. I'm going to say good morning. I'm Anthony Forgione. I'm the Director of Business Development for the HIA-LI. And welcome to our complimentary webinar on financing in turbulent times. The HIA has been putting on a number of complimentary webinars to not only support businesses across Long Island, but to keep you educated and informed. You know, the HIA has been very involved with Suffolk and Nassau County in helping businesses, helping communities coming out of COVID. Right now, we're involved with the Suffolk County Department of Labor and working with manufacturers on educating people in vulnerable neighborhoods, which make up a lot of the staff in manufacturing companies. So we're very excited about our participation. So today we have financing in turbulent times, a very important topic and subject that we're dealing with. So today we have Neil Seiden, who's going to be a speaker. Neil is the principal Asset Enhancement Solutions, a financial advisory firm that provides both investment banking consulting. AES is specializing in arranging debt and equity financing for companies with challenges. AES has arranged over $500 million in financing for middle market companies, public companies, and small business across various industries. Neil is periodically quoted in the New York Times, Newsday, Long Island Business News, and is a frequent panelist of symposium focused on financing. Mr. Seiden has been a past president of Long Island chapter of Turnaround Management Association and past president of the Long Island chapter of Institute of Management Accountants. And he's currently on the board of directors of the Middle Market Alliance of Long Island. So we're very excited and happy to have Neil joining us. And Neil, I am going to turn it over to you to start us. Go ahead, Neil. For some reason, we can't hear you. All right, we did hear Neil before, so we're obviously just having a little technology. Yeah.
I'm going to exit and come back in, Anthony.
Okay. All right, you do that. So just bear with us, everyone, while Neil does that. And while Neil does that, I do want to thank the sponsors of today, B&B Bank, AVZ, Print One, Compel CEOs, and of course, Asset Enhancement Solutions. So we want to thank all the sponsors, because sponsors are the ones that really get these webinars and get our programs going. And we'll wait for Neil to sign back on. And I think he's signing back on right now.
Okay, can you hear me now?
I can hear you now, Neil.
All right, that was interesting. Okay.
Okay.
So you're gonna let me share the screen, right? I guess
You can share the screen.
Host, disable participants. Screen share. It's not allowing me to do that, Anthony.
1 second. You should be able to share your screen now, Neil. Neil, I can see your email, so you have to share your presentation. Neil, you're still on mute. I can see your thing. Just take yourself off mute.
How about now?
We can hear you.
You can hear me?
Yes, go ahead.
Okay, great. Okay, good morning, everybody. We're going to talk about some of the creative solutions that are available to companies that have been hurt financially by COVID-19. And unfortunately, there's a lot of companies hurt by COVID-19. And unfortunately, there's a lot of challenges that it's created. Okay. So what we're going to discuss is the solutions that can mitigate all these challenges and provide companies with liquidity. Because this pandemic has caused some of the most daunting financial challenges in our lifetime. Our business for 17 years is focused on helping companies with challenges, but there's no challenge like any of us has ever seen right now. Okay, so one thing that's going to be prevalent in this presentation is that when it comes to financing, especially non-traditional financing, is that beauty is in the eyes of the beholder. Who are these beholders? So a lot of these lenders that we talk about as being non-traditional financing consist of what are known as private lenders. The private lenders or finance companies are not subject to the same stringent regulations that commercial banks are subject to. And as they're not subject to those regulations, they're able to be more aggressive than commercial banks, which have to worry about the types of loans they issue, their equity, their cash availability, etc. Other types of non-traditional lenders are SBICs, which are small business investment corporations, BDCs, which are business development corporations, and we all have heard of the term hedge funds, which are very aggressive, non-regulated financial institutions. So this is just kind of a portrayal of what many have experienced the past few months, being potentially a non-essential business in this environment, where you see sales declining starting in March through April, as well as receivables, inventory remaining pretty much the same because the company may have ordered previously raw materials or a finished product, and it's still coming in and they haven't been able to sell too much. And their loans have increased because they needed to take out more money to have liquidity and operate. And the cash balance in this example went from 250,000 to 25,000. So these are things that companies are experiencing everywhere. They're also seeing a deterioration of the accounts receivable, their monies that are due to them from customers. And this is an example of a company that had accounts receivable of $1.2 million at the end of February, and it's down to 409,000 in the middle of June now. At the same time, accounts receivable with people not paying over 90 days, so that's 90 days from invoice date, back in February was only $85,000, or 7% of their total receivables, where in middle of June, that number may have gone up to 200,000, or almost 50% of their accounts receivable. So what this means is customers are paying very slowly. Companies just don't have the liquidity they used to have. So it's creating a lot of problems for people. Also, many companies borrow from, could be a bank or a non-bank, using what's called a loan borrowing base. And the amount of money that they have available to use at any given time is based on a whole set of formulas. And with accounts receivable decreasing due to sales, the aging out of accounts receivable, and if you look at the top, you see accounts receivable over 90 days would be what a lender here would deem to be ineligible. And that amount of money has increased each month, peaking in May at 250,000. And that has the effect of reducing the amount of money available. So if we look at the bottom line, we see a company in January had $1 million available to them at any given point in time. They could borrow that amount of money. Now, at the mid-June, it's down to $17,000. So the challenge is, what is the company now, with everybody going back to work, we're trying to get back to work, where's the liquidity to restart operations and resume their previous business? Okay, so companies right now need this, what we call restart capital. They want to push the button and get their plant and factories moving, and they want to roll out their vehicle stock. They may have vehicles that should be making deliveries, and a lot of equipment that should be working, but unfortunately, the way things are very challenging now. Another situation companies are facing is they may go to their existing lender and ask them to extend additional credit for the operations. Even if they have equity, for example, in a building like I'm showing here. This could be a case where a building could be worth $5 million, and maybe the company has a loan of only $1 million or $2 million. So one would think there's a lot of equity in that building, which is the amount of the fair market value of the building, less the loan outstanding. And a lot of lenders are being very cautious. And even though there's equity and other available, they're still not lending to people. Also, companies are going to other banks for loans and they're being declined. So it's a very, very tight and frustrating market for liquidity right now. A lot of businesses have a lot of product in inventory that they purchased previously. And that product, the invoices are in accounts payable, but unfortunately they don't have the liquidity to pay those invoices. And if they can't pay those invoices, that means they can't potentially get new product from those vendors. So it's creating a difficult situation for companies. I'm just wondering, would anybody does anybody want to share some stories that might be similar that they're experiencing? Okay, Stephen, I don't know if you're able to see anybody out there. Okay, we'll move on then.
Yeah, nothing in the chat, Neil.
Okay. So with everything going on now, what are the banks doing? Well, banks are all doing different things. There's some banks, like on the top left, that are not taking on new customers at the current time. What most of the banks have been doing the last few months is something called a forbearance agreement, where because of what's happened, many of their customers and clients have violated loan covenants. They've had losses, the ratios are out of whack. So many of the bankers have been spending time adjusting the existing loan agreements. Other banks have been beefing up their workout groups. A workout group is when people from the bank work on troubled loans, trying to, which require a lot of tender care and a lot of time to try to help fix the company and right the ship. So a company that may have had 1 or 2 people in their workout group now could have a dozen or more. So that's a big thing going on now in the banking world. And still other banks are asking their clients to exit the bank and find a new lender. This is from Paradise Island, an old TV show for you young'uns. So what are the options a company may have with their existing lender at this point in time? Well, lenders typically, if they lend money on a borrowing base or as a function of a company's accounts receivable, will typically lend up to accounts receivable that are 90 days old. Well, what a company could do in this environment is ask their lender to extend that 90 days to 120 days or even 150 days if they deem the customers that owe the company money to be potentially creditworthy and if they see some of that money coming in. Another thing a company could ask their lender to do, if they're borrowing on inventory, is to provide a higher lending advance rate on inventory, especially off-season inventory. And the way that works is, especially for a company or a large retailer with this significant amount of inventory, typically advance rates are different based upon the season in which the inventory is. For example, a company in the, outdoor furniture market, that whether it's a retailer or a distributor, to the extent they have inventory in their warehouse or in their stores now, they would get a very high advance rate from the lender on that because it's in season. And if the lender had to, God forbid, liquidate that inventory, they would be able to probably get a good price on the liquidation at this point in time, since we're in June and July and August are coming. And if they had to sell it and the liquidator had to sell it off, they could probably get a decent price and get their money back. But as you head into September, October, the fall, and the winter, what happens is the lenders reduce the advance rate on that particular inventory. So what a company could do to help itself going down the road is to negotiate a higher advance rate for their off-season inventory. Another thing a company can ask their existing lender to do is provide them what's called an over advance. So if the company is borrowing money using on a formula basis, an over advance would be money above and beyond what the formulas tell the lender that the company is eligible for. Many lenders will provide over advances, especially if they know the company a long time. The other thing that might be available is, I alluded to that earlier, is if there are other business assets that have equity in them, a company could ask that lender to provide perhaps a term loan or a line of credit against that asset. So perhaps you have a business that has its own building. That building may be in a different corporate entity, and the company perhaps is fortunate enough that it never needed to borrow money against that building, or they paid off the mortgage, so there's no loan on that building. Well, it may be available to use as collateral for another loan. If a business is not fortunate enough to have additional business assets, but they have personal collateral, such as a home with equity in it, or they may have stocks and bonds, that also could be used as side collateral for a loan. Another option, and one that we're seeing now used quite often, is for a company to get an incremental loan above and beyond what they have from using an SBA 7A loan or an express loan. The lender that you're currently with cannot refinance your existing loan with an SBA 7A loan, but what they can do is give you an additional loan amount using the SBA 7A or express loan product. Any questions?
There was one question that came in here, Neil, is can other assets be intellectual property? Which I guess
Yes.
are intangible.
Yes. Other assets could be intangible property. It could be trademarks. It could be brand name, if it's a good brand name with value, as well as other things. It could be engineering drawings. That's a very good question.
Another question here is, are these SBA loans, 7A loans, express loans different than the SBA PPP loans? And can you get an SBA 7A loan if you got a PPP loan?
Okay, well, the answer is yes, they're different. The triple P loans are loans that everybody's been talking about the last 3 or 4 months. Those loans are forgivable if they're spent, if the money's used a certain way. You can get an SBA 7A loan if you did get a triple P loan. Now, the difference with an SBA 7A loan is the 7A loan needs to be paid back, whereas the triple P loan could be forgiven and converted to a government grant. So I hope that answers that question.
Okay.
Now, if your existing lender is not willing to work with you, there are alternatives that you have as a company and a business. One such alternative is to go to a different lender that might be able to give you a higher advance rate, which is basically borrowing against your accounts receivable, and also a perhaps more aggressive advance on different aging buckets, like I talked about earlier. For example, a lot of companies borrow against their accounts receivable. Now, advance rates on accounts receivable can range from a low of 65, maybe 70%, to up to 90% in certain cases. So if you're borrowing only 65 or 70% and you're with a bank, and that bank is very conservative in that advance rate, well, you should maybe look around to see most lenders, especially non-bank lenders, will lend up to 85%. And depending upon the type of business and your type of customer base, you sometimes can go up to 90%. Also, if the lender is only lending up to 90 days from invoice date, you may want to pursue a lender that will go up to 120, and in some cases up to 150. Now, right now, everybody's very nervous. When the pandemic first started, and I heard from so many people, they're not paying their rent, they're not paying their payables. I think things have loosened and people are starting to pay each other, but there's still a lot of companies, as we know, that have receivables that are aging out. Money's coming in slowly from customers, but there are a few lenders that get it, know a good company when they see one, know, especially on a pre-COVID basis, that a company was maybe very successful. And so there's some lenders that will kind of overlook the usual formulas, these advance rates that I talk about, and will use common sense to evaluate a company and whether it's a risk that they're willing to take on. There's also specialty lenders that will look at things differently than traditional lenders. And these lenders can be more aggressive because they're really experts in a certain industry, and all their customers will only be in a specific industry. And that could be, for example, the staffing industry or the alarm, burglar alarm business. A lot of these lenders look at things very differently. They look at different metrics. Some lenders now are providing over advances to their clients to get them over the hump. Some are offering other flexibility. but others, some aren't. So if a new lender is willing to give you an overadvance, it's someone that doesn't even know you, you would kind of be surprising that your existing lender wouldn't work with you in this, crazy time to give you an overadvance. Another option is to refinance your existing loan with a larger SBA 7A loan. So for example, if you have a $1 million loan with Bank of USA and you're really looking for a $3 million loan now or a $2 million loan, and you want to refinance your existing $1 million, as I mentioned earlier, your existing bank is unable to refinance the outstanding loan it has with you. But you could refinance your existing and a larger loan with another lender using an SBA 7A loan. There's also something that's called a term loan or slash a merchant advance, or sometimes referred to as an MCA or a merchant cash advance. And I'm going to go into more detail on the bottom two items right now. Any questions?
Yeah, Neil, there's a couple questions here. I can put them all together. One is, what are the requirements in terms of whether it's an SBA loan or anything else do you need audited CPA financials? And then what are there typical monthly or quarterly requirements once you do get a loan?
So you know what, I'd like to defer those two questions if we can till we're going to talk about SBA 7As a little more.
Okay.
But again, there are lenders that some lenders get it, some lenders don't get it. Okay, we're going to move on then. Let's talk about SBA 7A loans now. SBA 7A loans can be used for working capital, which is to fund new business, inventory. It can be used to purchase machinery and equipment for your operation. And that machinery and equipment could range from yellow iron, forklifts, to racking systems, to computers, as well as office furniture. You could use an SBA 7A loan to buy real estate, owner-occupied real estate, working capital to fund the growth of your business. And also the SBA 7A loan is a perfect tool to use to purchase a business. What I mean is an existing business, it could be a competitor, or to purchase a franchise, whether it's a new franchise that you're going to start or an existing franchise. It's a good way to start a business. You could use an SBA 7A loan to start and launch a business, or it could be used to refinance existing debt. So if you're using a factor or some other finance company, you're paying interest rates in the low or mid-teens, or even believe it or not, some companies pay sometimes rates in the 20% range. You could use a 7A loan to refinance that debt to a lower cost debt. The range of SBA loans ranges from $25,000 to $5 million. The repayment terms can vary from 7 years up to 25 years, and it all depends on what the money is used for. If it's used for real estate, you pay it back over a 25-year term. Equipment, it's typically based upon the life of the equipment. So if you were to buy computer equipment, the life would be a lot shorter than it would be if you were going to buy machinery and equipment in a factory. Purchasing a business, you get to pay that off over 10 years. And typically working capital is over a period of 7 or 10 years. The SBA 7A loans are typically term loans, where on a monthly basis you will repay interest as well as principal. And there are some lenders that will work with you and provide an interest-only loan for a period of maybe 6 months or 12 months. And that's if you could demonstrate that you kind of need that relief and can't really pay the principal back. And right now with the COVID situation, that would be something that I believe many lenders would do, and as well as businesses should request from their lender. The interest rate on an SBA 7A loan is based on the prime rate, the Wall Street Journal rate, up to a maximum of 2.75%. Lenders have their leeway in amount that they want to charge, but they can't go over 2.75%. There are some lenders that will work with companies and do a 7A loan and maybe not even charge a premium over prime. And they do that just to get a less risky loan. But up to right now at a 2.75% above prime, that would yield an interest rate of 6% today. Now, the SBA threw out a big bone to everybody in April as part of the CARES Act. What they did was said that they will pay 6 months of debt service on behalf of a borrower if they closed an SBA 7A loan prior to September 29th, 2020 of this year. Okay? And when I say pay, I don't mean defer and it gets added to the back end. What I mean is they will pay the first 6 months of all your payments on your loan, whether you're taking out a $500,000 loan or $5 million loan. So just to give you a little range of what that savings would mean to a business, if you borrowed, you did a 7A loan for $500,000 with a 10-year amortization period, you would save $33,306. If your loan amount was $5 million, your savings would be $333,062. So we are recommending companies right now, really evaluate and probably look at the benefits of an SBA 7A loan, and we're going to talk about more of those benefits. But it's now is the time to do an SBA 7A loan if there ever was. The eligibility for an SBA loan is based on a different criteria. And at the top, I just want to point out, we say that these SBA loans right now is a perfect product for challenges and the adversity that many businesses are experiencing. So the eligibility is based on typically a few different factors. It could be revenue or the number of employees. So what's interesting is you could have, for example, a manufacturing company that has up to 500 employees is eligible for an SBA 7A loan. But a retailer that has 500 employees may not be eligible, or a distribution company may not be eligible. So it all depends on the industry. Construction businesses are based on revenue and up to 28.5 million. Different contractors will qualify at the $12 million level. So what you really need to do is speak to an advisor that will check for you, or a lender, and it's based on the NAICS code, which is a code that for those that applied for the PPP loans, it was a code that you needed to provide when you applied for that loan.
Neil, there's actually a question that came in that that's relevant to that, which is, are there particular lenders that are good for particular industries, and how do you help somebody find that?
Are we talking about 7A loans, or are we talking about all types of loans?
Well, it wasn't 7A loans, it was all type of loans. So they're better lenders for better industries.
So the answer to that question is yes. It all depends on the industry. If it's a distribution, well, yeah, even distributors and manufacturers, there are some lenders that are better with those. There are certain companies that specialize in lending to staffing companies. There are lenders that specialize as alarm companies. So it's really interesting that there are a lot of niches, and the answer is yes. It all depends on the industry, and we'd be happy to share that information if they reach out to us and let us know what industry they're in.
And another question is, can you use 7A loans for anything? Can you use it for salaries? Can you use it for operating expenses? Are there any restrictions of what you use the loan for?
So let's go back to that slide then. So this is the uses of SBA 7A loan. in the middle where it says working capital. So working capital is operating your business. So that's for running your business, salaries. What was the other item, Stephen, you mentioned?
It was salaries really was the main question.
Yeah, so yes, so that SBA 7A money you would use to fund your operation and pay salaries, bring in inventory, equipment, stationery, supplies, pay your rent. So it'd really it's the same as any other type of loan. 7A money, they don't want you using that money and speculating on real estate. So it's really for, at least for real estate, it's for owner occupied real estate, not speculative real estate. But really it's anything that's needed to operate and run a business. So what's interesting about an SBA 7A loan is the loan is not made by the SBA. The loan is made by a bank or a non-bank lender that have the approval by the SBA to issue 7A loans. Okay, what the SBA does, they provide a guarantee of up to 85% to the lender that's making this loan. And some lenders, or what are referred to as preferred lenders, they're able to underwrite the loan and make the decision, or let's just say the SBA has confidence in them, has seen enough of their work to know that they will make the right decision. And what one of these preferred lenders do is just really request a loan number, an SBA approval number from the SBA. Whereas companies that are not preferred SBA lenders, until they become a preferred lender, they have to provide all the information. They actually have to underwrite it themselves, and then the SBA has to review the work and underwrite it themselves until they become a preferred lender. The beauty of a 7A loan, it allows lenders to be more aggressive. And this is because it's reducing the lender's risk, because the SBA is guaranteeing up to 85% of that loan. Offhand, I think that 85% guarantee is up to a loan of maybe 150 or 350,000. And that guarantee goes down to 75% on the larger loans. But still, it's a huge lifesaver for a bank and allows them to be more aggressive. So let's talk about an example here. So if a bank has the capacity to issue a conventional loan or an SBA 7A loan, okay, and a prospect comes to that company, the bank could turn down the loan on a conventional basis, but they may approve it on an SBA 7A loan basis, okay? So a lender that has the ability to do both conventional or 7A loans is really a very good, is in a good situation to be in these days. In terms of pricing, a healthy, well, we'll come back to that in a second. An SBA 7A loan has the effect of evening the playing field. Let's take a company that needed a $5 million loan to operate its business. If this company was been around a long time, they would go for a conventional loan. Now, a conventional loan, the prime rate, which is the rate that lenders use to base their pricing on, is now 3.25%. And the prime rate is the rate that people really refer to as the rate that very good customers, healthy, established companies, public companies would pay. A lot of times they pay lower than the prime. But let's just say a privately held Long Island company could pay the prime rate of 3.25% for a $5 million loan. To get that conventional loan, it had to have been around a long time, very profitable. The lender would want to make sure that the owners of that company were strong personally, had good credit scores, good personal financial statements and that the company had good collateral so that the lender, God forbid, had a second way out to get out of the credit facility. On the other hand, someone can get an SBA 7A loan. It could be a startup, or it could be a company with a lot of challenges. Especially now, the 7A loans are ideal for companies that are battling from COVID-19. So these same companies could get that same $5 million loan. They're going to pay a higher interest rate. They're not going to pay 3.25% that somebody with a conventional loan may pay, but they'll still be able to get that $5 million. Now, the SBA requires all available collateral as part of the regulations of SBA loans. However, a company that lacks collateral is typically not disqualified from being eligible for an SBA loan. So it really, really evens the playing field. Now, on a $5 million loan, the difference in interest rate of 3.25 versus 3.25 plus the max of 2.75 on a $5 million loan on an annual basis is only $137,500. Okay, so so that says a lot. Again, if we compare a conventional loan to a 7A loan, conventional loan, to receive that, you've got to be profitable on a historical basis. You need to have good collateral, and the bank has to look at you as being a low-risk company. On the other hand, a 7A is totally different. To get a 7A loan, you can often get it looking at projections that have realistic assumptions, and there's a good story behind it. A lender now making a 7A loan is not going to look totally at the future. It's going to look at your pre-COVID business, your performance, and the feasibility of you turning around the company from where it is now to where it may go in the future based upon how you did in the past. The other beauty is that with that guarantee, it reduces the lender's risk. And because the term of the loan is very long, up to 10 to 25 years, gives you the flexibility of, if things should possibly go wrong for a year or two, you have plenty of time to catch up, get back on track. So a lender making a 7A loan is really really reducing its risk. And a company is allowed or will have the opportunity to borrow more money than they typically would be able to with a conventional loan. And I think that's a very important factor to understand, that you'll be able to borrow a lot more money with a 7A loan than a traditional conventional loan. So it's really an excellent tool for businesses that are battling to fight back and regain its footing after COVID. There's also micro loans. Now, Stephen, you had questions before on the 7A?
Yeah, the only question was about, the financials, and are there requirements for audited financials, and what are once you get a loan, what are the requirements going forward in terms of reporting?
Okay, and that's another benefit of the 7A loan, is that when you apply for the 7A loan, the lender's looking for, believe it or not, for those of you that have gone through rigmaroles, only tax returns. They do not require audited financial statements on the way in or reviewed statements. They typically base it on tax returns. And on a go-forward basis, they don't require weekly, monthly, or quarterly reports like conventional lenders or asset-based lenders or factors, where sometimes you actually will do reporting on a daily basis. So the other beauty of an SBA 7A loan is very minimal reporting, and you don't need audited statements, et cetera, like you may need for conventional lenders.
Just one more question, Neil, which is, does Asset Enhancement do 7A loans?
We're not a direct lender, Stephen, but we arrange and assist companies get 7A loans, and we've done dozens over the years. The SBA has another product. It's called microloans. It's for the smaller companies, perhaps startups, and the loan amounts range from $1,000 to $50,000. Now, an SBA loan, with all the benefits, one of the potential drawbacks is that it's very paper intensive, and typically the quickest amount of time it could be approved, what I would say would be between 5 to 8 weeks. But if a company is seriously being hurt and challenged by COVID and money is needed very quickly, there's something that's called a term loan or merchant cash advance that can be closed, and the company can get funding within 7 days or even less. And it's a term loan. Usually the repayment is on a daily or a weekly basis. The cost is expressed as a financing fee as opposed to interest expense. And the reason these lenders do that is because the rates that they charge, one might consider to be usurious, which is meaning very, very, very expensive. So the way they use their financial and closing documents is a way that they manipulate it such that they're not brought up on usury charges. So that's how they present their fee. And the fee is shown typically as a factor, and I will show that in a minute. And typically an MCA, merchant cash advance lender, does not need to be in the first position on the capital stack. They'll come in behind an existing bank lender or other type of lender, or even in a third position sometimes. Many existing lenders, whether they're commercial lenders or asset-based lenders, are not too happy with these merchant advance companies. They do provide a service. They bring new money into a company, which helps kickstart a company. But on the other hand, because they're repaid on a daily or weekly basis, these lenders look at that cash going out to the merchant advance company as potentially money that the company can't pay back them back with. So it's really a trade-off as to whether an MCA is a positive or a negative thing in the market. In terms of UCC1 filings, which is a security interest, some file these, some don't. The amount of money that an MCA will advance typically really depends on bank statements. Quite often they don't even look at tax returns or other financial statements. And issues that may create problems for banks are typically not a problem for merchant advance companies. I talked about the rate being expressed as a factor. So on the top, I'm showing usually the repayment periods are in intervals of either 6, 9, or 12 months. And those repayment terms dictate the financing fees that these lenders will charge. So I'm using in this example, $100,000 loan amount, and a 6% fee on that would be $6,000. Going down at the bottom, if a factor or a financing fee were 42%, that would, or they call it a factor of a 1.42, the financing fee would be $42,000. So there's really two groups of merchant cash advances. There are MCAs that will lend money to what are considered to be good quality and healthy companies. And then there are ones that will lend to those that are not good quality, or they're just a high cost lender. And it might be that the borrower doesn't really know that they're expensive MCAs as well as inexpensive MCAs. So this chart is just showing, based upon the different months and the different financing fees, what the weekly repayment would be. Okay, as you can see, if you're not considered to be a good quality and you have to pay a financing fee of 42%, well, what does that tell you? That tells you the interest rate, or if you take 42,000 divided by 100,000, that's 42% right there. but the fact that you're paying it back on a weekly basis takes that 42% interest rate and bumps it up to something probably close to 70, 80, maybe even 90%. It's a little complex to actually figure out what the effective APR rate is, but it's a very high rate. So you could see one may want to use this as a last resort. I use it for clients in the past because it's so expensive as rescue financing. So if I have a client that is not, I wouldn't consider to be good quality, has issues, or may have something that's coming up, a very good big sale, or a big accounts receivable being collected in a month or two, and they need this money to survive, we may look at a MCA. On the other hand, if I have a company that's good quality that needs money quickly and may not qualify for other types of financing, I may use a lender that can provide a good quality MCA at what might be a reasonable rate. COVID has caused extreme disruption to the supply chain, as we all know. A lot of companies have no inventory. Their warehouses are empty. And these are perhaps the companies that were essential and sold a lot of product. On the other hand, there are companies that were not deemed to be essential, and people really, there was no demand for their product. So in the case of this company, looking at the inventory, we're in the summer season now, and it's a picture of a company with very small amount of summer and fall inventory, which they may need for whether it's fall clothing or back to school. On the other hand, they were still not able to sell all the inventory they had in for the spring season. So that's creating a lot of challenges for companies that are distributors and manufacturers of product. On the other hand, there are companies that are so fearful of the disruption in the supply chain that they're loading up on inventory as quick as they can, and they're in constant search of financing to load up on the inventory because they're afraid their vendors are going to go out of business. Then you have companies that are converting from retail to e-commerce. And that's happened over the course of the last few months, and they've needed new merchandise, and they've had challenges on how to pay for this merchandise. A lot of suppliers, unfortunately, have gone out of business. It's created a lot of challenges for people. A lot of companies are diversifying their suppliers. They see what has happened overseas. And it's not that easy to now in this environment to get credit from a new supplier that doesn't really know you. So this is in a case where they either are trying to diversify and reaching out to new suppliers, or if they're being forced to find new suppliers because their existing ones are out of business. Fortunately, there are certain lenders that provide what's called as inventory financing. One of the questions was asked earlier about specialty lenders. Well, there are specialty inventory finance lenders. They will finance inventory that's in transit, which allows the supplier to get paid for the inventory prior to you receiving it. This is an excellent tool when you have a supplier that requires a deposit or a supplier that will not provide you any credit. So if they're not supplying you credit, these lenders will typically will lend up to 75% of the cost of that product. So just to keep it simple, if you're going to buy, if you're looking to purchase $100,000 worth of product, the inventory lender will pay on your behalf $75,000 to the supplier. You have to either pay, if you had to pay all of it up front, you'd either have to pay that 25% or $25,000 up front, or the supplier would give you credit for the $25,000. So at least the supplier, in their mind, is getting 75% of that money up front. Stephen, are there any questions?
Nope, nothing right now.
Okay. So we put together a little example here. We called it two companies. one company, Unhappy Industries, who decided to be cautious. They didn't want to pay the higher interest rate. And for example, this inventory lender that I was referring to, their all-in rate is very high. It's 20% interest. But by paying that higher amount, the other company, Prosperous Enterprises, was able to carry an additional $500,000 of inventory, whereas Unhappy Industries wanted to be conservative and just kept inventory level of $250,000. These companies are, it could be competitors or in different industries. They turn their inventory, let's say 6 times per year. Okay, what that means is they refresh or bring in new inventory. Let's say in the case of Unhappy Industries, about $1.5 million a year of inventory flows through their operation. They both have a similar gross margin of 50%. Unhappy Industries is paying only 5.25% in interest. Well, what happens? Because Prosperous Industries took on more inventory and they had the same 6 times turns, they were able to generate sales of $9 million. Their interest expense was high. It was $100,000 versus $13,000 for Unhappy Industries, but they generated a gross profit after interest expense of $4.4 million, where Unhappy Industries only generated about $1.5 million. So the ability to bring in and acquire a lot more inventory, especially if you're pretty confident you could turn it and sell it, even though you're going to pay a lot more in interest, will generate a lot more profit to your bottom line. Let's take a look at companies that had issues prior to and post-COVID. And they're the same issues. They're companies that weren't paying their taxes, whether they be personal or business taxes. They had Uncle Sam money or New York State, whether it's payroll taxes or sales taxes. A lot of companies have messy record keeping and can't prepare adequate financial reports and accounting. And lenders need that type of information in order to provide funding. They don't just give people money. You often have to provide financial reports, tax returns, etc. So these are other challenges that these businesses may have. It could be owners with low FICO scores, low net worth, companies that had losses turned down by other banks. They may have violated covenants with their existing banks. They could be in a forbearance agreement with their bank because they violated those covenants. However, they may have accounts receivable and inventory, which is a good thing, but no cash. This is a balance sheet of a company just like that. They have accounts receivable, they have inventory, but they have a little cash. Okay, a company like this can benefit from something what's called an asset-based loan. Now, these asset-based loans been around for many years. And again, we have a lot of clients that use asset-based loans pre-COVID. Now, post-COVID, it may even be more appropriate for companies to use this, similar to companies now using 7A loans a lot. So an asset-based loan or an ABL loan is a revolving line of credit. It's secured by receivables and inventory, sometimes by machinery, equipment, and real estate. It's appropriate for some of the situations and challenges that I mentioned. And it could be used by distributors, manufacturers, service companies that generate receivables, and retailers, as I spoke about earlier, with different inventory advances, as well as e-commerce companies that don't really have receivables. They take credit card payments, but they have enormous inventory, whether it's in the hundreds of thousands or in the millions and millions of dollars. We've helped retailers with asset-based loans, as well as e-commerce companies get financing. Also, there are some lenders that will not lend against inventory that's at an Amazon warehouse. While Amazon provides very good financial reporting, and you'll know exactly to the SKU and quantity how much inventory you have in an Amazon warehouse, what the problem is, it's a problem for a lender to liquidate and access that inventory. So there are some lenders that will not lend against inventory in Amazon warehouses, but on the other hand, there are a lot that will. So if you have a lot of inventory at an Amazon warehouse and your lender is not lending against it, you should know that there are others that will lend against it. Now, I talked about companies with issues. Now I want to refer to companies that have real bad issues. And these could be significant legal issues, losses, problems with suppliers, heavy tax issues. And there's still hope for companies in that situation, both pre and post COVID. This would be a balance sheet with a company with a bad balance sheet. And you notice they have accounts receivable here of about $250,000, very little inventory, and they have a negative net worth of $200,000. These companies could use something what's called accounts receivable financing, or what's known as factoring. Now, these lenders, what happens in this situation is a company will sell its accounts receivable to one of these lenders, and they make the loan. They make this. They loan the company business money based upon the customers, not the company's ability to repay, but the credit worthiness of the customers that the company is selling to. And there are two costs involved. There's typically, there's a cost for on a monthly basis based upon the amount of money that's given the company. And there's also a small percentage fee that a company will pay to the factor. And in this case, to mitigate their risk, these factors have the business's customers pay the factor directly. Will go through a lockbox so that this way they don't have to worry about trusting the business to remit funds to them. And you should know there are both bank as well as non-bank factors. Factors that are owned by banks are less expensive than non-bank factors. And factors, just like other lenders, are very different. They look at things differently. Some of them specialize in certain industries. Some specialize in government factoring. Any questions, Stephen?
No.
No? Okay. Situation where factoring is appropriate. We discussed some of these: losses, tax issues. This also is available for anybody that's creating any invoices: distributors, manufacturers, service companies, companies that bill by the hour, taxi companies, trucking companies. Now, with everything going on, and a lot of people, nobody paying each other, at least in the beginning, people want to do business, but a lot of fear of extending credit to either existing customers as well as new customers. So there's a tool, a very good tool that's out there that's called non-recourse factoring. It's more expensive, but what happens here is that the lender takes the credit risk that your customer will pay them. So as long as you perform the service properly and deliver the service or the product, the lender will take the risk of that company going bankrupt and not paying. So that's the good news. The bad news, it's more expensive, probably twice as expensive as regular factoring. But if you build that into your pricing, it'll allow you to make sales and do business you otherwise would not have to do. So if you're pondering whether to ship a product to a new customer or an existing customer, this product called non-recourse factoring, especially now, is a very important product that could actually help companies become liquid and grow themselves out of the holes that everybody is in right now. Okay, let's take another situation here. Let's say it's a food company and they receive a large order from a company, a well-respected company that we could all consider to be a healthy, profitable company. They get $1 million order but they don't have really cash to purchase goods to sell to them or make the goods. So this might be the balance sheet that this company has. They can get $1 million order from a big company. If they went to a bank with this balance sheet, the bank would laugh at them. That's the bad news. The good news is that there are specialized lenders that are called PO finance companies that are a solution to this exact situation. These lenders will advance money to your suppliers, allowing them to ship you product. So it's really it's short-term funding to finance the fulfillment of a purchase order from a credit-worthy customer. So the PO finance company, they're not looking at you with your weak balance sheet. They're looking at Whole Foods, and what they do is they confirm that Whole Foods indeed sent you an order, and they'll do a credit check on Whole Foods, and they will ship the goods to Whole Foods on your behalf, and they will require Whole Foods to pay them, the PO finance company, and the PO finance company will take its fees and remit you the balance of the money it's due. And using PO financing, it's really an excellent tool because you could finance 100% of the product cost, the freight, and any duties that might be involved if you're purchasing from overseas. So it's excellent for anybody that is buying and selling product. In situations, and this is really important to understand, is you want to use this where you're not getting credit from your supplier. Also, it also levels the playing field, just like an SBA 7A loan does. It will allow a very small company, maybe one or a 2-3 person company, to potentially bid on municipal or government contracts, RFPs that have to be submitted. It allows them to bid on 5, 10, 20, 30, $50 million projects or opportunities where previously they never thought they could do that before. I also say it's an alternative to other financing because I once got a call years ago from somebody that had an order from, I think it was a school district for uniforms. And they were looking for, I think, $250,000 or $500,000 from an investor, and they were willing to give up a certain percentage of equity in their company just to fulfill a purchase order from a credit-worthy customer. So we worked with them. We were able to get them PO financing, and no way did they have to come close to giving up any equity in their company. The other thing is, let's say you do have cash. Okay, you have a big order for, let's say, the Whole Foods order for $1 million, and let's say you have $1.5 million in cash, but you got to pay that supplier that wants to be prepaid $1.5 million. Do you really want to risk taking $1 million out of your bank, your cash account, and pay it to a supplier in this crazy time right now in COVID, when we don't know what's going to happen? So we suggest that people conserve their working capital. If working capital is scarce and tight, save it for a rainy day and look at a product like PO financing so that they don't risk losing all their cash. And as I mentioned, PO financing provides opportunities and will allow companies to grow significantly. PO financing can be used in conjunction with an existing lender, whether it's a bank, an asset-based lender, or a factor, or any other type of lender. Typically, you need an intercreditor agreement between the PO finance company and the other lender, and this benefits all parties involved, including the company. It benefits the bank in that if a company could use PO financing and make some good profit that they otherwise wouldn't have made, it makes the company healthier and that customer healthier for the bank. There's something that's called an inventory line of credit, or also referred to as trade finance, and it's short-term financing for the purchase of inventory for future sales. And I haven't read the word future sales because PO financing, just by the nature of the word, is for when you have a purchase order from a specific company for finished goods. Okay, and I don't think I mentioned that before, but with PO financing, you need finished goods. Now, this inventory line of credit is a good product for certain industries or certain companies when there's seasonal demand. Companies that sell a lot of Christmas holiday products that may want to bring product in September to get into stores to sell to retailers. So they may buy bulk, and when they buy bulk, they may get some discounts by bringing containers and big shipments in. Take another industry like back to school. Usually we see at the end of July, early August, all the stores, the drugstores will all start carrying school products. And that's another good use for this inventory line of credit. And the way it works, the customer or the business will place an order with their supplier. The inventory lender will pay the supplier directly, and then the business will pay the lender back typically within 120 days. And that repayment time is usually done on a basis in which you can convert the inventory to cash in enough time to pay back the lender. So using the examples of the back to school and the Christmas holidays, by bringing it in a few months beforehand, the product in bulk, where you can get a discount, you should be in a position to pay that back in about 4 months. And this inventory line of credit is really anybody that carries inventory, and it could be consumer products or industrial or commodities. Any questions, Stephen?
Yeah, the one question that came in is that there seems to be quite a bit more that what you're talking about than what my bank has spoken about. Does it cost me more money to talk to Asset Enhancement Solutions than it does going to a traditional lender?
Most of the lenders that I described are specialty lenders. They're looking at things differently. They're taking risks. And taking those risks, whether it's PO financing or factoring, that requires more people to manage the transaction usually. Whereas the bank is lending to low risk, high quality companies, and they perhaps have less, and they have people that, they have, on the other hand, they have regulators and they have a lot of compliance people. But because of the risk involved, and these finance companies are often borrowing the money from other lenders, and there's a markup on that money, they have to charge a higher amount of money. But while they charge you a higher amount of money, it can provide you with the liquidity to do things that you can't do with your existing lenders. So it will probably cost you more, but as we saw in the example where we had the two different companies that viewed inventory differently, one stocking up on it, the other being very conservative, the one that knew they would be able to make those inventory turns even with a higher inventory level was able to make $3 million extra than the other company that was more conservative. So I hope that answers that question. There's another type of financing, and let's say you're a manufacturer, okay, and you receive a $10 million purchase order. Well, you need labor, you need overhead, you need raw materials. There's something that's called work in process financing. And in work in process financing, these lenders will fund the material needed that needs to be manufactured. With purchase order financing, the lender was financing finished goods, finished product. In the inventory line of credit, the lender was financing finished product, but there was no purchase orders on it, okay? Here, you have a riskier situation where a company needs to finance material, direct labor, and all, their rent and overhead. So lenders that are looking at these types of loans do a lot of due diligence. They need to make sure that the company is a going concern, that they're going to be in business, that they're somewhat healthy, that they have the manufacturing expertise and experience, that they've made these products before, and perhaps this is not the first time they've made this particular product. They want to make sure, and I've seen this where they look at the product costing and the manufacturing process, and they actually will bring in experts that understand manufacturing and costing to make sure that the company is actually going to make money on the manufacturing, and that there's also enough gross profit to repay and cover the cost because it's expensive. And most importantly, they need to have a valid purchase order from a credit-worthy customer. I had a situation years back where we did some work in process financing for a company. And it was sad but true, is that when the lender brought in an expert to look at the costing and the manufacturing process, they actually found and ascertained that the company was making a lot less money on the product than the company thought. So it was really a reckoning, and it was actually very helpful to the company. They didn't get the work, they didn't get the financing because the lender saw they wouldn't be able to pay for it because they weren't making a lot of money on it. In fact, in some cases losing money, but it did teach the company to change its ways and get a better understanding of what it was doing. You also have something called contract manufacturing. This is a situation here, a picture of a bottler that is making custom juices for a distributor of juices. Now, this particular bottling company is very busy all the time, and for them to be in a position to take on somebody's product, they want to make sure they get paid. So quite often they will require a seller of juice or other liquid products to pay a deposit of up to 50% to reserve time in their bottling plant. So there are lenders that will do these funky kind of things for companies. So if you're in a situation where you need to manufacture or get product, and we have some other slides, there's many different creative ways of bringing in product that you maybe never knew before. So I want to review, and actually I prepared this slide this morning because I talked about a lot of things regarding inventory and purchase orders. So on the left side are the types of financing available where you need a purchase order, where the lender will not provide the financing without a purchase order from a credit-worthy customer. And to review, those are PO financing, contract manufacturing, and work in process financing. On the other hand, if you're looking to bring in general inventory, just to have in your warehouse, and you're not sure who might be that is going to purchase that inventory, lenders that will finance that inventory would be the inventory financing lender that I spoke about. An asset-based lender will provide in advance. We talked about the inventory line of credit, trade finance. If you needed money quickly, you can get a term loan or a merchant cash advance. You could use an SBA 7A loan for inventory, as well as a micro loan. Or you could be with your current bank and you have a line of credit or a term loan, and you could use all those types of financing for inventory or to fulfill purchase orders. A lot of companies today have a challenge of they got to retrofit the new workplace. So on the left, where people work in cubicles on top of one another, now there's partitions and other costs that need to be purchased to satisfy today's workplace. Also, relating to that, you may need new furniture and other computer equipment. So a good way to finance these types of assets is using lease financing. You don't really want to, these assets are kind of long-term assets, and you don't want to use working capital or cash, especially if it's kind of scarce. You're better off financing it with a leasing company or some other type of company over a term of 3 to 7 years, which would make it a term loan, and really conserve that working capital for a rainy day. You can also use a 7A loan or term loan, merchant advance, or other type of financing for the retrofitting of your workspace. We're getting close to the end. If you're short on cash, but you own real estate, okay, if you have a big building, you own it, but you're real short in cash, you have major problems, and you have a lot of equity in that building, what you might be able to do is what's called generating cash from a sale leaseback of real estate. And what you do is you sell the real estate back to a particular sale leaseback company or lender that does that, and you lease it back to them over a long-term lease, could be 10 to 25 years. The pricing, both the rent as well as the sales price, is based upon the market value, and that typically will be determined by appraisers. There's some very notable sale leasebacks that people may not be aware of, and one was the Citibank building in Long Island City. Citibank had owned that building, and about many years ago, sold the building in a sale leaseback transaction to Rexon and leases it back. New York Times had owned their building in the city, and I believe they did a sale leaseback on possibly 50% of their building. Okay, so those that can do a sale leaseback, or those that own owner-occupied real estate, it could be a department store, chain, franchises, distributors, manufacturers, restaurant chains that may own a standalone restaurant, could do a sale leaseback. A lot of gas stations and convenience stores own their own properties and have done sale leasebacks because they didn't want to be real estate owners. And as I mentioned, even banks themselves, whether it's a building, or I know of bank branches, individual bank branches where the bank sold the real estate and started renting it back from somebody. Now, if you're short in cash and you own machinery and equipment, you could also do the equivalent of a sale leaseback on that machinery and equipment if there's a lot of equity in that, which means the equipment either has to be paid off fully, or there's a very small amount of money left on it to a lender. Now, with real estate, you typically get 100% of the fair market value. With equipment, it's very different. You would get 50 to 80% of the liquidation value or the orderly liquidation value of the equipment. Let's say you're a contractor now doing business. A lot of us know that most lenders don't like to finance contractors, especially there's a lot of things that could go wrong. It's not an exact science. It's subject to errors, and a lot of lenders are weary of contractors. But let's say a contractor lands a large project. Again, the bad news is banks don't like contractors. The good news is that there are lenders that specialize in financing contractors, and these lenders understand and specialize in monitoring the progress billings, the AIA billings, and what they do is they get confirmation from the general contractors or others that are managing the site that the contractor has completed its work and is due payment. And it is that verification that gives this lender the confidence that they'll be paid and the willingness to make this loan. There's also, this is the last slide, there are also lenders that I talked about will then contract manufacturing, as well as other types of production or other types of work where there's certain agreed upon deliverables. For example, film production. Somebody making a film could finance part of their production if the folks involved are willing, or if there's a contract, and in that contract, there's milestones that indicate that when certain work is completed, they'll be paid. Most people will not touch that or finance that. Same with other work in process types of things, but there are specialty lenders that will take the time and be creative, and we'll finance companies that have complicated billing situations and long-term contracts with deliverables. So as I started out in the beginning of this discussion, and as you can see, there are specialty lenders. They all look at things differently. So our motto is that when it comes to financing, beauty is in the eyes of the beholder. So I hope we help people understand, at least acknowledge the challenges that have been brought to them and caused by COVID, and that there are a lot of solutions that they probably might not have known about that could really help them turn their businesses around, get back on their feet, restart their businesses, and so they could be prosperous again. Do we have any other questions, Stephen?
No, nothing.
So
If anybody does have any questions, I did send Neil's contact information in the chat to everybody.
yes, and they have my contact information, so they can reach out to me and I'll get it to Neil. So Neil, I want to thank you first of all for that presentation. I mean, there's obviously many avenues for a company depending what your specialty is for funding and financing. So this presentation was excellent. I want to thank all the attendees today for joining us. I hope you found this very educational and useful for your business. As last thing, we have just some upcoming events. Actually, June 25th to June 29th, we have the HIA-LI virtual run, walk, and exercise. That's, if you want more information on that, you can contact me. Everything is on our website. On July 9th, we have our Small Business Task Force meeting. On July the 13th, we are featuring Paul Pachter from Long Island Cares in a CEO forum. And July 22nd, we have Discover Long Island, which is going to be a wonderful panel made up of Angie Carpenter, Kristen Jardigan, about talking about the new norm when it comes to travel and tourism. So once again, Neil, I really want to thank you for all this information. This was wonderful. And I want to thank all the participants for coming in today.
Our pleasure, Anthony. Thank you for having us, and I hope information is helpful.
Yes, it was. Thank you very much.